and welcome back to the Ducoscopy Studios here in Geneva. I'm joined today by Dooley Awadalla from Lumina Investment Funds. So Dooley, welcome back to the studios.
Thank you, Jessica.
So we've seen a lot of market volatility as of recent. So how has the commodities reacted to this?
Well, we've seen a general shoot in the price of most commodities. Gold has perhaps fared the best, having only dropped about 10%, but most other commodities we've seen them come off their highs by about 20 to 50% in some cases. And this is across the board. So we've seen it happen with metals, we've seen it happen with oil and energy commodities, and we've seen it happen with food, wheat, grain, etc. In general, I think also the Chinese market, the sputters we've had lately, it's important to remember that gold might have held a little bit slightly its value because it's seen more as a store of wealth, whereas other commodities tend to be linked to industrial purposes. So, for example, platinum, I think about 90% of the world's platinum is used in car catalyzers. So the price of platinum, for example, is very linked to the demand for cars. And with China taking such a large amount of the percentage of commodities, so let's say at the moment they use about 50% of the world's copper, nickel, zinc, and iron ore, and about 15% of the world's oil, 30% of the world's platinum. So any slowdown in the Chinese economy will obviously have an immediate effect on commodity prices.
Sure. And Goldman has recently made a statement saying that $20 per the barrel when looking at oil is actually possible. So what do you think about this?
Yeah, I think a lot of economies will suffer if that happens, and a lot of governments have based their budgets on higher figures. But it is definitely possible in the short term. I mean, what we see at the moment is a lot of downward pressure on oil as well, coming from, we've had a lot of high demand. So we've had high supply. Demand slowing down, particularly again coming from China, etc. So, and the problem with oil is that there's always a lag between an investment. So whenever there's a change in demand or supply, it takes a very long time because oil investments tend to be long term. So it takes a long time to see that change in market demand or supply actually have an effect on oil output. So what we'll see is probably downward pressure still, oil prices remaining low for, let's say, 2016. But then as oil prices remain low, then you'll see investments will be either cut or deferred in the industry. This will in turn reduce supply as demand increases. And we expect to see, in 2017, the demand estimates would require substantial investment. So in order for this to happen, oil prices have to go up. So at some point, in the short term, downward pressure. But definitely I expect them to move relatively quickly in 2017.
Okay, and then looking at precious metals, so we've seen China's market volatility. There's a question mark over the US raising interest rates. So how could this affect precious metals?
Well, if the US raises interest rates, then obviously there'll be more demand for interest-bearing US dollar investments. And as precious metals do not bear any interest, then you'll see normally a shift into the dollar. You'll see an increase in the value of the dollar, and you should see a decrease in the price of gold and other precious metals, assuming, of course, that an interest rate hike happens. Now, personally, this is all good in theory, but personally, I don't see this happening that quickly. And even if the US does decide to change rates, it will be more or less window dressing. It will be a very small move. I don't see them raising rates substantially in any way, while the ECB and China and Japan are still going through a phase of quantitative easing in order to boost growth.
Well, Dooley, thank you so much for taking the time to come in and speak with us today.
Thank you for having me, Jessica.
And thank you for watching. For all the latest Ducoscopy updates and interviews, do keep clicking back. Goodbye for now.